Good afternoon and welcome to this installment of Epic Insight. This is Brian Lenz, Director of Sales and Strategic Partnerships here at Epic, and I'll be your host again for today's call. We thank you for joining us for a presentation from Joe Labella, Retirement Strategist at Voya Investment Management. Joe's going to summarize some of their findings that choosing funds with a proven and sustained performance history creates better long-term results. He's also going to showcase Voya's consistency lens process to help identify these types of funds and implement them to reduce stress and manage client expectations within your retirement plan practices. In Joe's role as a retirement strategist, he works with Voya's intermediary sales and business development teams to provide advisors with unique, strategic, and consultative discussion points on key retirement issues while providing investment expertise in the form of portfolio evaluation and analysis. Your line will be muted throughout the call today, but certainly if you have any questions for us, enter those in the questions panel of the GoToWebinar pane there, and we'll field those at the end of the call. Without further ado, I'll turn it over to Joe Labella of Voya Investment Management. Joe, take it away.
Well, thank you, Chris, and good afternoon, everybody. Thank you for having me. I'm going to talk about, as Chris said, tapping into the power of consistency. This is a tool that Voya Investment Management has developed, and it's really designed to help identify actively managed funds who can deliver consistent returns with lower volatility. The methodology will help assist you and your clients on managing their fears and expectations, lower stress across your clients' practices, and potentially improve investment outcomes, especially when it comes to personal retirement and DC client accounts. Just a little background before we begin about myself. I spent over 20 years in the financial services industry, managing money for advisors, constructing ETFs and asset allocation models. I did a lot of marketing of global research, and I've worked for the likes of Morgan Stanley and UBS. Most recently, I was managing money for an RIA in New York. In short, I've been a financial advisor's advisor, and I'm dealing with a lot of the issues that your clients are dealing with when it comes to managing their practices, especially when it comes to fund selection and building portfolios, constructing portfolios. Hopefully after today's discussion and the presentation, we'll get you one step closer to helping them really develop a robust fund selection process. I do want to do like a 30-second commercial for Voya. Obviously everyone's seen the orange squirrels and bunnies, but Voya Financial was divested from ING over 4 years ago. We are entrusted with $500 billion in clients' assets across 3 business lines: their retirement solutions, investment management, which is what I'm part of, and insurance and annuity solutions. So basically, we plan it, we invest it, and we protect it. One fun fact to know about Voya is that 1 out of every 5 adults in America has some sort of relationship with Voya. We are a publicly traded company, Fortune 500, and we have the easiest tickers to remember, VOYA. Now, the asset management arm, the investment management arm, which I'm part of, manages over $200 billion in assets. We're taking a page out of our parent company. Our parent company is trying to be America's retirement company. We want to be a reliable partner for reliable investing. So you're going to hear the term consistency a lot in my presentation, and that's rooted in our philosophy, our investment philosophy. We take a long-term, risk-efficient approach where we try to maximize returns and minimize volatility. We have 200 investment professionals assisting our clients in helping them achieve their long-term goals, aka retirement. So with that out of the way, I do want to tap into the agenda today. Over the next 20 minutes or so, we're going to talk about really 4 things. What's best when it comes to fund selection. 2, identifying and analyzing consistent fund managers. 3, applying it to your practice or your client's practice. And 4th is basically, which we'll have time for, your questions and hopefully my suitable answers. Let's get into what's best. Before we do that, we have to look at consistency. Obviously, the topic today is consistency matters. The power of consistency. Why is it so important? Well, if you think about it, consistency helps you make better decisions. It actually helps you potentially avoid mistakes and helps you better prepare for the future. That's for anything, specifically when it comes to investing. And it's the basis for creating good habits. So consistency is not one size fits all. Clearly, depending on who you talk to, it means different things. Now, I'm talking about investment consistency. I'm not talking about oatmeal or grits. That's a completely different type of consistency. For example, if you think about an investor who's looking to accumulate wealth, they take an aggressive strategy. So consistency to that person is going to be, how much money I can make, how can I maximize my gains. If you go along the lifestyle of investing, you have someone who's maybe in that maintenance phase. They're transitioning towards retirement, maybe within 5 or 10 years of retirement. Consistency to that investor is going to be maybe a balanced strategy. Don't rock the boat. And finally, once you have a client that's in retirement, well, then consistency to that person is going to be stability. Don't blow me up. I made a lot of money, or you put made a lot of money for me. I don't want to lose it. I really want to enjoy my twilight years. So again, consistency matters, and it matters differently to different people over different circumstances. Now, if you look at behavioral financial research, there's plenty of that out there now. It's a new thing. Actually, they've shown and proven that clients hate losses twice as much as they like gains. So if you think about it, that's when we come to making financial decisions, sometimes we make the worst possible decision just at the worst possible time. And why is that? Because we're wired to do it, and that's in our DNA. We have the fight and flight mentality. It's kept human race alive. We don't analyze things very carefully. We make decisions, snap decisions, and we go from there. Unfortunately, in financial investing, that's the worst possible thing to do. So we've all heard of the herd mentality, right? The hot dot. These are things that really can destroy or upend a client's investment strategy or philosophy. So if you look at that next page, this kind of actually proves the behavioral concept in real financial terms. So on this, you see the chart of the S&P 500, Barclays Ag, the average asset allocation for investor inflation. This is over a 20-year period, going back to January of 95, ending in December of 2014. And frankly, this study's been done so many times over so many different time periods, it really doesn't matter. The same thing holds true, is that the typical asset allocation, the typical investor barely outperforms inflation. And again, this just shows you the hot dot mentality, buying high and selling low. So it's actually the antithesis of consistency, which is what we're trying to fight against. So let's go to what's best. Now, when I used to manage money for advisors and for endowments and 401k plans, my job really was to put together an asset allocation, and the building blocks of that was fund selection, finding that manager that can fit into that asset class or sub-asset class. And we struggled. We struggled is what is best? Who is the best manager out there? The other thing we had to consider is, volatility. It's great to have a manager that can perform, performance-wise beats the benchmark, but how do they handle that volatility? And how do they handle it through market cycles? And we know over the last 20 years or so, markets have been extremely volatile, more so than we predict. So it's important to have a methodology or an ability to actually look through and find those active managers that can really help us not only provide consistent excess return, but be cognizant of the downside volatility, which we'll talk to in about a minute. So like I always say, when it comes to fund selection or trying to find the best return for the lowest amount of risk, it's not easy to do. I'm reminded of my longest serving client, which is my wife, who tells me, look, you're the expert, make as much money as possible, but don't take any risk. And then again, I know it sounds ridiculous, but that's sometimes the boat or the area that we think we're in, where we get cornered into that area where we have to perform that way, and of course that's kind of ridiculous. So looking at our example now, what I show here is a real-world example. This is something that we've done in the past, and I'm sure you've come across this. When it comes time to do a fund selection and you're looking at an asset class, in this case we're looking at large cap growth mandate that we have to fill. And what you see here is really the index returns on the horizontal axis and the manager returns on the vertical axis. And we're showing you a time period ending in December 31st, 2014. The upward sloping line is the Russell 1000 growth. That's our benchmark. And so like many times I've done this where I go to a database, I go to my usual criteria of selecting fund managers, and I press the button, and out comes this analysis where I find a large cap growth manager that's really outperformed the Russell 1000 on a 1, 3, 5, and 10-year basis. And not only that, when I looked at my database using Morningstar, it's a 5-star rated fund. So clearly we've done our job, so we think. We've done our due diligence. We have a 5-star manager in the large cap growth space and actually beats on these trailing return benchmarks. So then over time, the performance starts to lag a little bit, and so now we're in April of 2016. I run the same analysis again like I did before, and lo and behold, this manager, which was a 5-star manager, which had outperformed the benchmark, now can outperform the benchmark in any of those metrics, the 1, 3, 5, and 10. And shockingly enough, it's no longer a 5-star Morningstar fund. It's now down to 4. So what did we do wrong here? Well, we really didn't do anything wrong. We followed, usually what the industry does, the industry standard, looking through Morningstar, finding those 5-star funds, looking at something that can beat the benchmark on a 1, 3, 5, 10-year basis. But when we do that, if you think about it, we're actually looking almost in reverse. We're actually driving by looking through a rearview mirror. If you look at this next slide, you see on the left, this is what you bought, right? You bought great performance over time and fit the category that the client needed. And then, of course, this is what you got on the right. You got something that couldn't outperform the benchmark. So, again, something's wrong here. We have some flawed analytics. Now, there is a silver lining. On the next page, you should see that the manager, again, no fault to him or her, during this period that your client was invested in this fund, those 15 months, they netted $5 billion in cash flow. That's a large chunk of money. So again, nothing wrong. They did the same, formula when it comes to managing the fund that they've always done. But unfortunately, for the time period that your client was in the fund, they underperformed. So we need to do something better. And again, we know that it's difficult to find good managers that are consistent over time, that are cognizant of downside volatility. We know that past markets are important, but they're not the end-all, be-all. And of course, future market events are even more important. But the problem with that is, I don't know about your crystal ball, but mine ain't working too well. So it's really difficult to kind of predict with absolute certainty what the future is going to hold or what's out there. So I think what we've got to do is we've got to take that rearview mirror that we've been using, driving down that financial road, and combined it with the so-called crystal ball to come up with the lens. And the Voya Consistency Lens was developed out of our research, like I mentioned before. We spent years trying to develop this and take the best of what's out there and kind of put it into context of finding those managers that can distribute excess return over the benchmark and that's cognizant of downside volatility. What we found is that there are factors or characteristics that when you utilize them and combine them with a rolling return time set, you can develop a much more robust analysis of active managers. And you can do it consistently, not just in one asset class, but in many asset classes. So the initial methodology page, which we will make available for you, started with 10 Morningstar categories, covering over 1,000 funds, and about half of which were fixed income, half of which were equities, to really develop and show statistically significant improvement of excess return over the benchmark. Now, bringing it up to speed to today, the lens currently can analyze 24 Morningstar categories, over 7,700 actively managed funds, and over 95% of all fund families with $10 billion in assets under management. So it's clearly a robust tool, and the efficacy still works. It's still able to find those fund managers that have excess return and are cognizant of downside volatility. Now, look, this lens is important. We think it's definitely going to help you and help your clients and your clients' business, but it's not the end-all, be-all. We're not asking you to use this to replace what your clients are currently using, but we think this is a good add-on. This is an extra check on what they're currently doing. I've spoken to many advisors in the broker-dealer space. I've spoken to many RIAs, and they kind of use it in different places. Some use it in the beginning as they build their asset allocation, looking at different asset classes. They use it kind of in the middle sometimes as they're doing their due diligence, and at the end as a final check. So I guess the punchline is, use it, just use it, right? Either it's in the beginning, middle, or end. So I think it's a valuable component into any type of analysis that you're doing for clients. So let's open up the hood and take a look at this lens. I mentioned before that we use rolling returns because it's much more robust when it comes to finding managers that have a certain amount of skill as opposed to luck. Now, nothing wrong with Morningstar. I think it's a great company. They've definitely built an empire on their star system. The data that they have is tremendous. In fact, that's what we use for this consistency lens. We use Morningstar. However, if you take a look at trailing returns, again, this is an industry standard, the 1, 3, 5, and 10, you're really left with 4 data points. And of course, you all have the same ending point. So it really doesn't give you any type of picture of what that manager has done over time. It's pretty scarce. Whereas rolling returns, especially rolling 3-year returns, again, that's just 36 months of performance, and then you move 1 month up, you take 1 month off, and you repeat the process. If you use that, say on a 5-year period, 5-year time period, you're getting 25 data points. On a 10-year period, that's 85 data points. So clearly, more data points are better. You get a much clearer picture of what the manager is doing over a market cycle. And that's what we used. The other thing, too, with trailing returns, tends to have a recency bias. And what does that mean? Just it means when you look at the numbers for 1, 3, 5, and 10, obviously in the 10-year number, you have the 1, you have the 3, you have the 5. But what happens is it tends to overweight unduly the 1-year and 3-year performance numbers. So you're not getting a real consistent picture or return over time, whereas the rolling return time stream definitely does that. It kind of almost equalizes the weighting over a 10-year period or 5-year period. So let's go back to our example in the large cap growth space. We see here that that manager that we picked that really didn't do too well, actually, if we look at it on a rolling return basis, did okay. What you're seeing here, again, is an upward sloping line. That's the Russell 1000 Growth Index, and each dot is that 36-month time period I talked about. So not only did it actually outperform the benchmark 57% of the time, it actually kind of shows you now really what this manager is doing, how they're leaning. And what I mean by that, if you look at the index returns, which is plotted on the horizontal axis, when the indexes are doing really well, when they're up 10, 20%, this manager is outperforming. When you look at those dots, they're all above the index. So it shows you that obviously it's an aggressive manager. Now, when the index is pretty much hovering around flat to 10%, it's actually underperforming. And when the market is down in a correction, this manager definitely underperforms. So clearly we have an idea now. We have a much more robust analysis of what this manager does and how they act during different market cycles. Now here comes the shameless plug. This is the Voya Large Cap Growth Fund, and it's outperformed the benchmark 70% of the time. But again, the point here is not to gloat about Voya Large Cap Growth Managers, just to show you that on the 36-month rolling periods, you see how those dots form. Again, when the market's doing really well, up 20%, the Voya fund is kind of hugging the benchmark a little bit. When it's 0 to 10, we're actually outperforming, but where we really do well is when the index is negative. And so we outperform by a tremendous amount. Again, it really shows you how this manager behaves under various market conditions. Which leads us to the factors or the characteristics. Now, we've come up with 6 factors, really modern portfolio theory statistics, return-based statistics, that help really pick and identify those managers that have that excess return. There's a high correlation if you score very well on average on these 6 factors. Now, I know it's late in the day, and I don't really want to go through formulas. I just really want to go behind, I should say, focus on the math behind these ratios a little bit, the meaning behind, I should say. On the right-hand side, we laid the factors out. This is kind of a 2-dimensional chart. All this is saying, if you look at the bottom orange dot, that's the average Morningstar return for the 10 Morningstar categories we did the methodology report on, the initial paper. And it just shows you what the average excess return is and what the average overall downside volatility is. And as you can see, the factors above it, 5 of the 6 factors actually do better both on capturing excess return on the upside and also reducing downside volatility. The only one that doesn't reduce downside volatility is upside capture, but it clearly adds a tremendous amount of excess return. So this just kind of shows you statistically how these factors really help on differentiating a universe of actively managed funds, again, across the original 10 asset classes. So now I'm going to take you through quickly the factors, and again, not really in any order of importance, but there is a method to my madness here. The first one is R squared, and this is really a goodness of fit test. So it's really looking at the diversificational style purity. And why is this important? And again, the larger the number, the higher the number, the better. This is really trying to find out if that manager is playing in the appropriate sandbox. If they claim to be a large cap growth manager or high yield manager, are they getting a good chunk or a majority of the returns from that index? Now, most people say it doesn't really matter. But what happens is when you're building asset allocation, again, these are the building blocks. If you put the wrong fund manager in the wrong asset class, that can come back to really bite you, because when the performance starts to wane or there's something wrong with the performance and you find out that the R squared was low and getting lower, you realize that the returns were never generated from the so-called asset class or sub-asset class you had put that manager in. So you create faulty asset allocation. So it's really important that the R squared be score pretty high because it's really a validity test. If you think about it, it validates not only what you're doing when you're putting portfolios together, but also validates all the other statistics we're going to look at. The next one, information ratio. This is really a measure of skill, manager skill. Do they have it, or are they just lucky? And obviously, I know the saying, "You'd rather be lucky than good," but clearly, when it comes to investment management, you want to be able to find managers that have repeatable skill. So in that case, I like to use baseball analogies because baseball is definitely full of statistics, and the one that's comparable to information ratio is on-base percentage. So if you think about on-base percentage, it's the percentage of times a batter gets on base by the number of at-bats he has. So again, the many ways you can get on base: you can bunt, you can get hit by a pitch, you can hit a single, you can walk. And if you have a player that can do that repeatedly, game in and game out, they definitely have a skill. Same thing for an investment manager. You want someone who has a skill set that can actually score really well over time and be consistent. Next one is Sortino ratio. Now, Sortino ratio is really a measure of risk or volatility, and we took it upon ourselves at Voya Investment Management to find not only factors that obviously can attract managers that have a skill on outperforming the benchmark, but we really wanted to be cognizant of volatility. And the Sortino ratio really shows what we mean by that, because it's really a derivation of the Sharpe ratio. The Sharpe ratio really is a risk-adjusted return, and it's a great statistic. It's used a lot. But what Frank Sortino decided, he was a professor, he said that if you look at volatility, which is also in the Sharpe ratio, which is standard deviation, it measures two things. It measures volatility on the upside and on the downside. So clearly, from an investor point of view, the client's point of view, they care about losing money, not necessarily making more money. So if you think about it, it's really the downside volatility or negative returns that impact the clients the most. So Sortino developed the ratio where you can set a target, and for our methodology report, we decided using 0. So what it does is it measures the probability of a manager giving you negative returns. And when you look at this, you want to have the higher number, the better. The analogy here I'd use is really if you go to the doctor, you get a blood test, you get your cholesterol number. The number could be 300, 200, but that's really not the number that's important. It's really, good cholesterol versus bad cholesterol. And it's the same thing when it comes to Sortino. You're trying to differentiate the harmful volatility from the general volatility. Upside capture, as the name would imply, this is looking at those managers that can outperform the market when the market's moving higher. So the baseline is 100%. So if you have a manager that can score 110, they're doing much better than the market. And really what it shows is a manager's skill on finding undervalued securities in the benchmark and then outperforming the overall benchmark. The reverse of that is downside capture. Again, when the market is down, can you find a manager that can avoid those landmines? If a manager is successful in doing that, they will do much better overall. Again, the baseline here is 100%. This is the only one of the 6 statistics where the lower score is better. So obviously, if you can do 80% of the downside, you do much better than capturing 100% of it. And then finally, if you think about it, the research we did, it's very hard to find an active manager that can do both great upside capture and downside capture. So what we did is we just divided the 2 ratios into each other to get a more general score, a level playing field, if you will, of managers through market volatility. So this is really a measure of versatility. How well can a manager perform in different market cycles? Again, it's a skill that some managers have and some don't, and it's really important when it came to constructing the lens. So here's kind of a breakdown, the 2 camps. So of the 6 ratios, we've got 3 that manage skill of the manager, information ratio, Sortino ratio, and overall ratio. And then we have 3 factors that look at the manager process of priorities: R squared, upside capture, and downside capture. And again, the important thing here is not that one ratio is better than the other. It's just that it gives you a sense of where the manager is relying on or where they're placing importance on. And that's important when it comes to portfolio construction. This slide, I call it the proof slide, because this is an example of the research we did. This is the large cap growth managers in Morningstar. You'll see the top gray line going back from 2005 all the way to 2015, so it's 10 years worth of returns. At the top green line identifies the best fund manager on a rolling 36-month period. So if you had the ability to guess or know which manager was going to outperform, then you would have the top gray line over that time period. You would have gotten a return of 17%. If you are unfortunate enough to have the bottom gray line, that is average return would have got you the worst manager over that time period. For rolling 36 months, you would have gotten negative 1%. So if you think about it, the difference is huge. It's 18% dispersion between the best manager and the worst manager to that time period. The dashed blue line is really the Russell 1000 growth. The return on that is 9% over that time period. So what I'm going to show you next is really the results of the Voya consistency lens. When you overlay the lens, you now shrink that universe of funds, and now you have the best performing fund manager at 13% and the worst performing fund at 9%. So again, the dispersion gap is closed now, going from 18% to 4%. So if you pick the worst manager, you did 9%, which ironically is identical to the index. So clearly this really demonstrates the power of the consistency lens to really help when it comes to fund selection. So the next thing is how we're going to use that when it comes to your practice. What's the case for consistency? So on the left-hand side, we look at investors. What are they concerned about? They're concerned about setting realistic expectations, improving retirement outcomes, and then obviously less stress. And look, we did a tremendous amount of research, and we did a lot of surveys, both internally and also bought a lot of surveys externally, and they all say pretty much the same thing, that clients really need help when it comes to retirement investing. In fact, one study showed that 75% of investors feel more confident in achieving their retirement goal when they work with an advisor or a professional. It helps them to kind of de-stress their portfolio. And then for the advisor or the investment professional, I mean, it's a great way to articulate your value. You can differentiate yourself from the competition, and we're going to talk about customizing it for clients as well. So this kind of gives you a snapshot, and I'm sure there are more things that are affecting advisors today. Obviously, the big thing is pressure from regulatory agencies, compliance, fiduciary rules, and whether or not you're dealing with them now or have been, things are going to get more and more, I guess, onerous in some cases. And the consistency lens helps in kind of defraying that uncertainty, or that as far as having an ability to deal with those rules that are coming down. Also, when it talks about market volatility, gives you the ability to really mitigate that, and again a way of differentiating your practice, and of course maintaining and building a book. So some statistics I just want to run through. 70% of advisors really feel that the personal retirement space is only going to increase. However, the same survey shows that only 16% of advisors feel that they're ill-equipped to become retirement specialists. Right? They just don't have the ability, or they don't feel like they have the ability to do that. This is an area where Voya can really help, and help advisors have the tools and expertise to deal with the increase in retirement accounts. Also, a thing to know that can help you is that when you look at the concerns that clients have, investors have, when it comes to investments, really managing portfolios, risk and volatility is the number one concern on the investment side, and then on the relationship side, managing client fears and anxieties are another key component. So what the consistency lens attempts to do, and with our professional development program, we really pride ourselves in having best industry practice to really help advisors deal with managing portfolio risk, and also dealing with the concerns in clients and the behavioral biases that investors have. This particular slide shows, again, statistics on the fact that we're living longer, we're healthier, and that's good news. The bad news is we have an issue when it comes to funding our life, right, and our lifestyle. So this just shows you on the left, it shows you the probability of living. If you're 65, what's the probability of living to 80? That's 65%. What's the probability of living to 85? That's 46%. And then to get to 90 is 26%. So if you think about clients and their book of business when it comes to individuals, maybe 1 out of 4 clients are going to live to 90 from the age of 65. So it's another 30 or 25 to 30 years that they're going to have to fund for their livelihood. And on the right really shows you where retirees and where workers really feel the source of retirement income is coming from. And again, if you're a retiree, you pretty much are going to rely on Social Security. If you're a worker, you're really going to rely on your own employee-sponsored or retirement plans or individual plans. So it's really important that we really help clients achieve those goals, retirement goals, and going forward. This other part I want to talk about is with the consistency lens, really talks about taking those factors that I mentioned before. And we know we can score and rank actively managed funds now in those various Morningstar categories. But now what we're going to do is we're actually going to profile those characteristics and align them with a client's retirement life stage. So if you think about it, I mentioned before about consistency and how it matters differently to different investors depending on their circumstances. So now you can see that you can actually bucket certain clients in certain life stages of retirement. So you have the accumulator, the pre-retiree, or the retiree. If you notice, those 6 factors that I talked about all show different weightings of the different factors. So if you think about it in the aggressive or the accumulator phase, information ratio is key. So is R squared. In fact, R squared is going to be consistent across all 3 of the different life stages of retirement. And overall ratio is key, and upside capture, right? So someone can take on more risk if they're in the accumulator phase. Those factors, those return factors are going to matter more. And as you shift over to pre-retiree and retiree, the weightings and the factors importance are going to change. So when you go to retirement side of things, upside capture is no longer important at all. It's really downside capture and Sortino ratio. Again, they're protecting their downside volatility. Information ratio is still a skill that you want to have in your manager across the board. So as you can see now, if you think about that, especially in the DC space, not only can you develop a plan, a menu for a plan sponsor, now you can go to that plan sponsor and say, now I can differentiate the plan participants depending on where they fit on their risk profile or where they fit along the retirement life stage. And so I think it's just a tremendous added value that you can give to clients. So to sum up, the consistency lens helps reduce, stress across your practice, helps you differentiate, demonstrate value added, and helps improve when it comes to retirement income, retirement accounts, and specifically on profiling clients to align those clients' risk perspective with the appropriate retirement stage. Which brings us to Retirement University for Advisors. This is the professional program that we've developed. We officially launched September 1st. This is a practice platform to really help advisors differentiate themselves, talk to their clients about retirement, hone their skills when it comes to retirement investing, and really help them build their business and their practice. We have a defined contribution segment as well as personal retirement section. The discussion we just had on the tapping into the power of consistency is our featured presentation. It's really 2 parts, right? So the investing part, which we talked about, the lens, but the equally important part is the engagement part. So no matter how great your investment strategy is, that can get sabotaged by poor planning, poor discussion with the client because of their knee-jerk reactions to things, because of the behavioral biases that we all have to overcome. So it's really important when it comes to the engagement side to really talk to your clients about that. Now, the good thing about the Retirement University for Advisors is there's a couple of parts to it. One is the brick part, which is like any university, we have bricks and clicks. So the brick part is myself and our professional staff to help advisors, help you, guide your clients to becoming a retirement specialist. And also we have the white paper and a lot of other brochures to help you with that. We've done seminars and presentations. On the click side, we have a website, retirementu.voya.com. And there, if you go there, you'll get entree into all the different tools that we have, the consistency lens or the diagnostic report that comes with it. Also, you have the ability to get 2 CE credits because we have 2 modules, one on the engagement side of things and one on the investment 360 side, and as well as other information and electorals you can take regarding retirement. So, and this is just going to get bigger and better as we build this out. So I'm just going to leave you with the phone number and also the web address here, retirementu.voya.com. Please reach out, register for the university today, and we can help you on doing a diagnostic report and utilizing the consistency lens. And with that, I'll hand it back over to Chris.
Thanks, Joe. I know we're a little bit over time here, but we did have a couple of quick questions that run in.
Sure.
Obviously, if you want to access this tool, the information's on the screen. It sounds like a fantastic thing to at least take a look at integrating into your investment screening process. It sounded like, based on the engagement side of your retirement university, that you have some maybe tips or materials that would help an advisor kind of translate what you've presented today that makes sense to an investment geek but would not make sense to the average plan sponsor, participant, IRA holder. Do you have materials, best practices on kind of translating this methodology and approach into something that actually makes sense for the end investor?
Sure. On the engagement side, what we try to do is we try to work on called reframing the conversation, or firstly picking up cues, like verbal cues that a client might be saying about investing, and then changing that and reframing it to help them, de-stress them or dealing with their concerns. So a lot of times clients might be fearful of the market. They don't want to engage in it. They don't want to invest in it. And we have ways on the website where we talk about how to get a client involved for investing for retirement, the need to do that, need to rebalance, the need to actually, think about long-term investing, not to be worried about market volatility in the short term, things of those nature. And it goes to two extremes: those that are very aggressive, that think the market's never correct, and that what happened the last couple of years is going to continue. So it's really designed to help all types of advisors, I should say all types of clients, and their kind of their behavior, and help you kind of defray that.
Excellent. Well, thanks again, Joe, and thanks to Voya Investment Management. And thanks to everyone for joining us for this installment of Epic Insight. We appreciate the partnership and look forward to seeing you on a future session.
Well, thank you again for having me. All right, you too. Bye.